Greetings, ladies and gentlemen, and welcome to the Valens Company second quarter 2020 financial results conference call. At this time, all participants are in listen-only mode. A brief question and answer section will follow the formal presentation. If anyone should require operator assistance during the conference, please press star 0 on your telephone keypad. As a reminder, this conference is being recorded. It is now my pleasure to introduce your host, Everett Knight, Executive Vice President of Corporate Development and Capital Markets of the Valens Company. Everett, please go ahead.
Thank you, operator. Good morning and welcome to the Valens Company's second quarter 2020 financial results conference call. A replay of this call will be archived on the investor relations section of the Valens website at www.thevalenscompany.com/investors. Before we begin, please let me remind you that during the course of this conference call, Valens management may make statements, including with respect to expectations or estimates of future performance. All such statements, and other than statements of historical fact, could constitute forward-looking information or forward-looking statements within the meaning of the applicable security laws and are based on expectation, estimates, and projections as of the date hereof. These forward-looking statements are subject to a number of risks and uncertainties that may cause actual results to differ materially from expectations. For more information on the company's risks and uncertainties related to the forward-looking statements, please refer to our latest annual information form filed with the Canadian Securities Regulatory Authorities at www.sedar.com or on the Valens Company's website at www.thevalenscompany.com. The risks described in such annual information form are hereby incorporated by reference herein. Although these forward-looking statements reflect management's current beliefs and reasonable assumptions based on current available information available to management as of the date hereof, we cannot be certain that actual results will be consistent with such forward-looking information, and we do not undertake to revise or update any such forward-looking statements in the future. We caution you not only to place undue reliance upon any such forward-looking statements. For reconciliation of non-GAAP measures discussed, please consult our MD&A filed on SEDAR. Joining me on the call today are Mr. Tyler Robson, Chief Executive Officer, Mr. Chris Bison, Chief Financial Officer, and Mr. Jeff Fallows, President. With that, I would now like to hand over the call to Tyler. Tyler, please go ahead.
Thank you, Everett, and welcome to everyone that has joined our earnings call to discuss our results for the second quarter ended May 31st, 2020. As we navigate the unpredictable events of 2020, I appreciate this opportunity to speak directly to our shareholders today and provide a corporate update. Later in today's call, Jeff Fallows will provide a more comprehensive update on our recent operational achievements. Everett Knight will provide an overview on our capital markets achievements, and Chris Bison will give an overview of our financial results for the second quarter. But first, I'm going to recap the last quarter's performance and talk about the trends we are seeing in the sector. Today, we are undeniably facing challenges that reflect the global volatility and economic uncertainty across each sector as a result of this pandemic. However, I would like to make clear that to all of our shareholders that despite the noise of the current environment, we are focused on executing our corporate strategy, maintaining profitability, securing solid partnerships that drive the most value for our sophisticated platform with a view to creating long-term shareholder value. Revenue for the second quarter 2020 was $17.6 million, a 100.3% increase from $8.8 million in the second quarter 2019, and a 44.9% decrease from $32 million in the previous quarter ended February 29, 2020. Gross profit increased to $6.3 million, or 35.8% of revenue for the second quarter of 2020, compared to $5.1 million, or 57.9% of revenue in the same period fiscal 2019. The decreased 65.1% compared to $18.1 million in the previous quarter ended February 29, 2020. Adjusted EBITDA was $2.7 million, or 15.3% of revenue for the second quarter of 2020, compared to $2 million, or 23% of revenue in the second quarter of 2019, and decreased 81.1% compared to $14.3 million for the quarter ended February 29, 2020. These results, while representing a pullback from our previous 5 quarters of quarter-over-quarter growth, demonstrates the continued advancement of our strategic plan amidst the challenging market backdrop. While demand for toll extraction has negatively impacted as a result of the current environment, our strategic plan has not changed. We have made significant progress on building our white label and custom manufacturing platform, in addition to working to secure more opportunities as they arise in this high margin segment. Again, this quarter, we attribute the decrease in toll extraction revenue and distillate product sales to the slowdown across the cannabis sector as we and our customers adopt to a more cautious approach to cost control, which we expect to continue into the third fiscal quarter. However, we continue to remain optimistic about the return of toll extraction volumes, as many LPs, including our customers, still have large dried cannabis inventories which they can better monetize through conversion to oil-based products. In the second quarter, we shifted our focus to extracting Valens-owned cannabis and hemp biomass, processing over 30,000 kilograms to prepare for an anticipated inventory requirements for 2.0 product offering in the latter half of 2020. Growing retail sales and many successful product launches across the country signal market demand for more 2.0 products. Regardless of the challenges presented in the second quarter, the Valens Company remained the partner of choice for many of the industry's leading licensed producers and branded companies, as we hold the necessary capabilities to successfully execute on every step of the product development supply chain. The increased revenue from our custom manufacturing, white label, and co-packing agreements is expected to continue as both new and existing customers recognize the value of our platform. We currently have a strong pipeline to support the future launch of 2.0 products in the marketplace. The several new custom manufacturing agreements we signed subsequent to quarter end are expected to drive significant revenue growth in the second half of 2020. Throughout the second quarter, we continue to execute on our existing contracts to support our customers as they introduce more 2.0 product formats to Canadian consumers. Our internal record of launching a new product in 44 days demonstrates Valens' commitment to our partners, as well as gaining available market share for our value-added products. I'll now turn the call over to Jeff Fallows, President of the Valens Company, to dive deeper into our operational achievements in this quarter and outlook on the rest of the year, as well as provide more details on how we are adapting to the current environment. I'll be able to answer questions at the end of this call.
Thank you, Tyler. As noted, it has been a challenging quarter as several of our customers have experienced reduced workforces and decreases in cultivation output, which have resulted in a reduction in demand for our extraction services. With this in mind, we are cognizant of the need to run our company responsibly and are carefully monitoring our concentration risk as well as the creditworthiness of our customers. We are also being selective in the extraction customers we are onboarding. Overall, we believe that we are navigating the current market challenges successfully and are making solid progress in expanding our custom manufacturing and white label business segment, which is a key pillar of our strategy and is expected to be the primary driver of future revenue growth. We believe we have the most advanced and adaptable 2.0 platform in the market to manufacture innovative and differentiated products, as demonstrated by our scale, diversity of our technical capabilities, and the quality of our products. This, together with the strength of our customer relationships, puts us in a strong position to be a leader in the industry, even with the market challenges experienced over the past several months. As a result, we are expecting aggregate EBITDA growth to accelerate from current levels, with the bulk of our growth expected to come in fiscal Q4 as a significant number of our new 2.0 products hit the shelves. While we are disappointed that the decline in revenue from extraction services has impacted our financial results for the quarter, we have made significant progress during this time to position our business to realize on the many emerging market opportunities we face. In addition to the white label partnership with A1 Cannabis Company, a subsidiary of Iconic Brewing, we continue to see growing demand for quality products in the market that have translated into signed customer agreements. Our customized offerings differentiate Valens in the market and enable us to empower our customers, gain market share, and expand our operations. We only expect this demand to grow as we bring hydrocarbon products, including crumble, live resin, and other concentrates, to market in Q3 and beyond. We are pleased that we have completed our first shipment of crumble at the beginning of July, the first ultra-premium concentrate offering in the country, in partnership with Verse Cannabis. Our pipeline of manufacturing opportunities extends beyond Canada, and we continue to engage in discussions with global players with a view to penetrating international markets and accelerating our growth as legalization spreads worldwide. We recently signed a 5-year distribution agreement with Canvalate, Australia's largest medicinal cannabis distributor and clinical research organization. We see great potential in the Australian market, as it is currently the second largest cannabis market outside of North America. The partnership provides Valens the platform to establish initial operations and pursue required licensing in Australia, bringing Valens high-quality oil-based products to a growing medicinal patient base and ultimately a broader consumer market. In the short term, we are focused on monetizing this agreement through shipments of a broad range of products from our facility in Canada to Australia, which we expect to start in the third quarter of 2020, subject to receiving the necessary import and export permits. We are also in the process of finalizing a long-term lease on a property in Australia with a view to building out a manufacturing facility that will serve as the hub of our operations in the country and grow both in scale and capability as the market demand dictates. Construction on the facility is expected to commence upon the signing of the lease and the facility is expected to be fully operational halfway through 2020 or through 2021, subject to applicable licensing and regulatory approvals. Our agreement with CanVlate is an important step forward in our targeted global expansion strategy, which focuses on developing distribution channels and near-term revenue opportunities with shorter payback periods rather than an asset-heavy model. As discussed on our last call, we expect global cannabis revenue within 2020 with the potential for facilities on the ground internationally in 2021. Meanwhile, we have seen an uptick in demand for 2.0 products in Canada and have signed several new custom manufacturing partnerships to launch a breadth of new products with leading brands. We entered into an agreement with Trek Brands to manufacture and sell vape pens as a new product format across 3 of their existing brands, with the potential for expansion to other products in the future. We also entered into an initial 5-year manufacturing and distribution agreement with Verse Cannabis to develop a range of high-quality products such as concentrates, vapes, oils, and water-based products, leveraging Sourced by Valens emulsion technology under 2 separate product lines. Both the Verse and Trek agreements allow a royalty-based payment structure and are expected to generate long-term revenue for the company. Other recent milestones include the launch of a premium vape line made by, in partnership with Burnt, the signing of an initial 2-year agreement with High Noon Brands to develop and manufacture a premium line of vape products under the Days brand portfolio, as well as a 2-year agreement with FTF Brands to develop and manufacture a craft line of hemp-derived CBD products under the You Feel You portfolio. As noted, we are pleased that, despite the challenging market environment, we continue to hit many critical milestones in the strategic development of the company and have made material strides in growing our custom manufacturing segment with many more opportunities under negotiation. We will continue to accelerate the scale-up of our product development capabilities by developing additional IP to launch several new product formats. We have manufactured a record 36 SKUs that exceeded our estimate of 25 mentioned in the first quarter of 2020 conference call, leading to increased Canadian market share. The number of SKUs in development, as well as product offerings, are expected to increase throughout the second half of 2020 as our white label and custom manufacturing agreements grow and revenue from extraction contracts contributes to a smaller proportion of total revenue. I'll now turn the call over to Everett Knight, Executive Vice President of Corporate Development and Capital Markets, to discuss our capital expenditure plans in more detail and some of our other initiatives to bring value to our shareholders. Everett?
Thank you, Jeff. To begin, I would like to thank our shareholders for the continued support as we navigate these uncertain times. We are looking forward to the future as Valens' platform expands and gains continued recognition for the value to add manufacturing services we have already successfully integrated into the supply chain of many leading companies. We aim to continue to get the Valens name in front of the necessary stakeholders to not only increase our exposure as a third-party manufacturer, but also to communicate the inherent potential we see in our business in the long term. In recent months, we have hit several exciting milestones that are aligned with our strategy to grow as a global cannabinoid-based product manufacturer and, importantly, deliver value for our shareholders. Our uplisting to the Toronto Stock Exchange on April 16th was a strategic move to support additional liquidity in our stock and broaden our reach within the investment community. We also successfully completed our continuance out of British Columbia to become federally incorporated as the Valens Company, a new name which we believe better reflects the strategic vision and identity of the business and in addition to these milestones, have seen our institutional research coverage expand. In order to strengthen our balance sheet, mitigate risk, and to allow us to continue to focus on growing our core operation, we entered into a syndicated credit facility as announced earlier in June with CIBC and ATB Financial for up to $40 million of secured debt financing at an attractive rate. This increases our confidence in our balance sheet and offers us a strong foundation that will allow us to leverage attractive investment opportunities as we emerge on the other side of the current market challenges. We believe our share price remains undervalued, and in the second quarter, we started to buy back shares under our normal course issuer bid as an effective and immediate way to return value for shareholders. The company acquired 43,600 of its common shares through our normal course issuer bid during the month of May 2020 at a price range of $2.24 to $2.25 per share. The company will continue to evaluate the opportunity to purchase additional shares under the normal course issuer bid in the coming quarters and will continue to provide updates to shareholders. We are making crucial strides developing our intellectual property that will support an attractive pipeline of opportunities. As Jeff mentioned, we are producing an ever-expanding range of SKUs, and our ability to efficiently and quickly turn around new products is constantly improving. To support these efforts, we are increasing our manufacturing capacity at our facility north of Toronto, which upon completion we expect to be used in the production of beverages, edibles, and source products. We are currently on track to have this facility operational at the start of 2021. The construction at our K2 facility in Kelowna is almost complete and is expected to be operational in the fourth quarter of 2020. Once this facility comes online, we will add increased scale to a number of our manufacturing capabilities necessary to meet the 2.0 market demand. We are currently a market leader in the 2.0 cannabis product space, but with these expansions, we expect to truly become a premier Canadian manufacturer of oil-based cannabis products with the ultimate ability to distribute products globally. We foresee the oil-based product market growing rapidly, and we believe it will eventually dominate the cannabis retail sales in Canada. We achieved our goal of reducing our accounts receivable balance in the second quarter. This is a result of the internal controls that management has put into place to facilitate appropriate payment terms and timeliness, ultimately creating a win-win scenario for both parties. We are working hard to have our AR continue to decline in the coming quarters, ultimately reflecting a decrease in AR as a percentage of revenue. As always, communicating effectively and transparently with our stakeholders and shareholders and maximizing return on invested capital remains core to our operating philosophy. We will continue to provide important updates to the investment community. Stay tuned. With that, I will now turn the call over to Chris Bison, CFO, to talk about our financial results.
Thank you, Everett. Based on industry-wide challenges driven largely by the COVID-19 pandemic, as highlighted earlier in this call, consolidated revenue decreased $14.4 million, or 44.9%, to $17.6 million in the second quarter of fiscal 2020, compared to revenue of $32 million in the prior quarter ended February 29, 2020. Revenue is comprised mainly of proprietary and industry-leading extraction, white label and custom manufacturing services, bulk winterized and distillate oil destined for Cannabis 2.0 markets, and analytical testing revenue. Revenue from the cannabis operating segment decreased to $17.2 million in the second quarter of 2020, compared to $31.6 million in the prior quarter ended February 29, 2020, as a result of reduced shipments of biomass for extraction, as our partners adjusted their workforce and operations to manage through the uncertainty created by the pandemic, in addition to a reduction in volume and compression in pricing realized on bulk, winterized oil, and distillate sales. We anticipate this moderation in extraction volume and frequency of shipments to continue through the third quarter of 2020, but anticipate this reduction to be partially offset by growth in revenue from existing and potential new unlicensed white label and custom manufacturing partnerships highlighted earlier in this call. Additionally, in the second quarter of 2020, the company generated $0.7 million in revenue from analytical testing through the company's ISO 17025 accredited lab, including $0.3 million in intercompany testing revenue. An increase from the $0.6 million in revenue, including $0.2 million in intercompany testing revenue in the prior quarter ended February 29, 2020. As Everett discussed earlier, the team remains focused on managing credit exposure with all customers. Trade accounts receivable decreased $12.4 million, or 29.5%, to $29.6 million at May 31st, 2020, compared to $42.1 million at the end of the prior quarter ended February 29, 2020. Of these trade receivables, 85% are held with 5 Health Canada licensed customers of the company. Subsequent to the end of the quarter, the company has trade accounts payable outstanding with the same partners, or has recorded an impairment loss provision representing 53% of the trade receivable balance, which supports the cash position of the company and speaks to the strength of our current relationships with our industry partners. Consolidated gross profit was $6.3 million, or 35.8% of revenue for the second quarter of 2020, compared to $18.1 million, or 56.6% of revenue for the prior quarter ended February 29, 2020. Gross profit from the cannabis operations for the second quarter was $6 million, or 34.7%, compared to $17.7 million, or 56.2% in the prior quarter ended February 29, 2020. Gross profit was impacted in the second quarter of 2020 by a write-down of oil inventory of $1.5 million as a result of compression in pricing of bulk winterized and distillate oil. The analytical testing operations saw an increase in gross profit for the second quarter of $0.5 million, or 69.7%, compared to $0.4 million, or 72.3% in the prior quarter ended February 29, 2020. Operating expenses for the quarter were approximately $10 million, compared to $11.6 million during the prior quarter ended February 29, 2020. The decrease from the prior quarter was primarily attributable to lower wages and salaries as a result of the Government of Canada's Canadian Emergency Wage Subsidy of $0.9 million, which was applied as a reduction to wages and salaries, lower share-based payments, and travel and business development as a result of travel restrictions in place due to the COVID-19 pandemic. These reductions were partially offset by higher professional fees and facility costs. Adjusted EBITDA was $2.7 million, or 15.3% for the second quarter of 2020, and decreased 81.1% compared to $14.3 million in the quarter ended February 29, 2020. For the second quarter of 2020, the company posted a net loss of $3.5 million, or 3 cents per share, compared to net income of $2.5 million, or 2 cents per share for the prior quarter ended February 29, 2020. During the second quarter of 2020, the company entered into a syndicated credit facility that will provide the company up to $40 million of secured debt financing at interest rates ranging from prime plus 2% to prime plus 2.5% per annum, depending on certain financial covenants. The credit facility consists of a $2 million secured term loan, which was fully drawn at May 31st, 2020, and up to a $20 million secured revolving loan, which has not been drawn at May 31st, 2020. In addition, the credit facility contains an accordion feature that could allow the company to increase the aggregate commitment by up to $10 million. The company had $45.1 million in cash and short-term investments as of May 31st, 2020, compared to $44.3 million at February 29, 2020. With that, I'll now turn the call over to the operator to open the lines for the Q&A.
Thank you. Ladies and gentlemen, we will now be conducting a question and answer session. If you'd like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you'd like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up the handset before pressing the star keys.
We ask that you limit yourself to 2 questions initially so that we have time to speak with as many of you as possible. If you have additional questions, please rejoin the queue and we will endeavor to come back to you later in the call. Our first question comes from the line of David Kideckel with ATB Capital Markets. Please proceed with your question.
Thanks, everybody, and congrats on the quarter, guys. I just had a couple questions here. The first, I want to circle back with kind of the expectations around tolling and extraction. Obviously, a bit of a disappointment, which is not at all your fault, coming from, I guess, many of the cannabis licensed producers. So I'm wondering, just from your expectations and how we should be thinking about this, given the great uncertainty with COVID-19 and the pandemic, and how this will further impact the LP's ability to really come to you as a trusted provider to extract product. How should we be thinking about the ramp moving forward, not just in the next quarter? I mean, given that we're, about halfway through this quarter already, but even into 2021, what are your expectations for tolling coming back, and why as well? Thank you.
Okay, thanks, David. This is Jeff. And just for those on the call, I'll be facilitating the questions and directing the questions, given we all can't be in the same location. I'll allocate those questions that way. And I'll take a first shot at your question, David. So obviously, it's very hard for us to predict what's going to be coming down the pipe in the wake of COVID and how quickly those extraction services will come back. But what we do know is, from a Valens platform perspective, we continue to offer the most diverse platform and scale available in the market to help LPs and players in the market to meet their ongoing requirements. So as we move to the next into the end of 2020 and into 2021, we continue to think that the cost profile and the flexibility that our platform offers will be a very attractive option when those extraction margins or extraction volumes do come back.
Yeah, and maybe just to expand, it's Everett, David. As we've discussed before, there's as Health Canada put last week, there's 620,000 kilograms of dried cannabis inventory on licensed producers' balance sheets. So it's not like there isn't a lack of dried cannabis inventory. What COVID has done is put pressure on their balance sheets, and obviously we're having conversations to get that back online. But if you just model out our manufacturing footprint today, the reason I view us more stable in this environment as a manufacturing company is really, as we've gone and not only have licensed producers on our platform, but as we've onboarded a whole bunch of these third-party players, whether they're CPG companies, whether they're brand companies that don't have licensing, what we've been doing is we've been distributing those manufacturing progress. And I think with the last 4 announcements recently, along with Burnt now in Alberta, you're seeing more visibility on that front on the platform, and you're seeing that really translate through in the financials, going from 9 SKUs in Q1 to 36 SKUs this quarter. And I would say, just modeling that, we have an attractive platform. And as these extractors come back in and figure out their balance sheet trouble, it's just icing on the cake for us.
Okay, thanks. That's very helpful. Moving on to your white label segment and custom manufacturing, a number of the deals, if not all of them, that have hit the wire over the last little bit, I think 36 in total, I think around 4 in the last 6 weeks alone. But there's obviously a royalty structure in place here, as opposed to the minimum supply agreements previously held as per tolling. I guess my question on the royalty structures, I'm going to assume that you're not disclosing specifics because you haven't previously, but how should we be thinking about these royalty structures as far as each individual contract? Are these based from your at the end of the day, your customer, and it depends what the sales they're bringing in, which will ultimately drive your royalties, or is it based on the quantities regardless of sales that you're producing? Thank you.
So the structure, David, of these arrangements obviously is different from customer to customer, but in general, the way you can look at it as the more that they are able to bring to the table in terms of sales team, marketing platform, or existing brand profile, the more of a royalty or the higher the royalty that will be allocated to that customer, the more we're doing and the more our platform is the key ingredient, the lower the royalty will be. But certainly as those brands begin to pick up momentum in the market and firmly establish their position, those economics may change as they prove that the brands can grab a spot in the market.
Okay, that's good. And if I can just sneak one more in here, just in general here, moving forward, what kind of new products is Valens going to be shipping out, and to which provinces? And also, if you can maybe include within that answer an update around beverages, and in particular the source beverages. Thank you. That's it for me.
Tyler, why don't you take a shot at this one?
Absolutely. Obviously, Tyler here. So looking at SKUs going out, a big one for us going forward is obviously vape pens. We believe we have the best product offering in Canada, especially with CO2 isolate and then live resin coming. Another big one for us, obviously beverage. We're launching drink drops with one of our co-branded partners. Different beverages going up to the provinces, which you'll see on shelves in multiple provinces in the very near future. Another one too is going to be topicals, and then a few other ones we're looking at. Obviously hydrocarbon is coming. I think we've officially launched in multiple provinces as of now. Sales seem to be going extremely well. So we remain confident in the SKUs going forward and the products we're offering and sales too. As we pivot away from extraction, we're really starting to push on white label and co-packing. So we're going to continue to accelerate that during this pandemic.
Thanks for that, Tyler. And then maybe just to follow on, though, from the beverage category, can you comment just overall, how are you seeing sales within the beverage segment to date?
Overwhelming, to say the least. So we knew beverages were going to be big. We didn't know they would go as fast as they did. So we're firing on all cylinders, trying to meet this provincial demand and supply right now, which we've had to ramp up our staffing and bring in more infrastructure, manufacturing equipment to try to ramp that up. So it's gone better than expected, and we'll continue to kind of push that. With so few players actually having fundamentally sound beverages, we're one of the only ones out there that actually creates a consumer experience with the accelerated onset and accelerated offset. So the feedback has been tremendous to date. So we're really going to take advantage of the unique opportunity we have.
Great. Thanks very much, and congrats on the quarter.
Thank you. Our next question comes from the line of Jenny Wang with 8 Capital. Please proceed with your question.
Thank you. Good morning. My first question is, during the quarter, you turned your focus to really produce and manufacture the 36 SKUs. I'm assuming most of these are 2.0 products. Can you give us an idea as to kind of what portion of these SKUs were for existing white label contracts that you've already secured, and what portion was really in anticipation of signing future contracts? The second part of this question is, would you consider directly selling maybe a part of these SKUs to provincial bodies under the Valens brand since you've already manufactured it? Thank you.
Maybe I'll answer the second part of that question first, and then I'll turn to Chris to maybe answer the percentages. But we are a third-party custom manufacturer. There is no intention internally on the Valens team to be launching a Valens brand. We want to make sure that we are providing our ongoing customers, current customers, and future customers with the ability to differentiate their brands and launch new products to the market. Chris, you want to address the breakdown of the sales?
Yes, certainly. So I guess from a sales standpoint, as we enter into these relationships with these partners, unlicensed partners, the inventory that we're manufacturing really is specific to that partnership that we're creating with them. So all of the SKUs, the 36 SKUs that we manufactured this quarter, would be for existing partnerships that were in place at that time, because it is a specific product that we're developing in partnership with each individual partner.
Okay, got it. Thank you.
And Jenny, you need to keep in mind as well too that when you announce a new agreement, we have a record where we launch a new product in 44 days into the market, but these things take a significant amount of time and effort internally to launch them. So not only is 36 SKUs sort of a Herculean effort, But the next step in getting these new products to market on these agreements we just announced, is also a lengthy process.
Okay, that's helpful. And maybe in terms of, could you give us some color on kind of the reception of your derivative products so far? Which categories are in demand by the provincial wholesalers, and which categories do you think are still underserved or undersupplied by the industry?
Tyler?
Yeah, so the two big ones for us at this point in time that are underserved is number one, hydrocarbon. We can't make it fast enough depending on any form factor of extract, so that's the number one, and beverages as well. Like I said earlier in this call, the consumer experience on some of these other beverages have been underwhelming. So the feedback on ours launched successfully has been tremendous. So I think those are the two biggest unique opportunities. But at the end of the day, I think the whole 2.0 category is lacking from some of our industry peers. So we have a unique opportunity. We truly believe topicals is going to be a very dominant player coming out, and we're really pushing on that, and a few other hydrocarbon extracts. So we're really, really pushing hydrocarbon right now, but I think the entire 2.0 category is lacking. Part of it, too, is consistency and quality and a price point that works for consumers, because a lot of these licensed producers have inflated cost of production to gain their profit or any margin and all that. They're pricing themselves out of the category and not moving essentially quickly. So with Valens value-add services, we can really kind of come in and undercut the market and push volume.
Got it. I'll jump back in queue. Thanks.
Thank you. Our next question comes from the line of John Chu with the Heart of Capital Markets. Please proceed with your question.
Hi, good morning. So maybe just stay on pricing then. Obviously, there's been pricing pressure on the tolling side. Maybe just talk about broader pricing trends, not just tolling, but what you're seeing on the custom manufacturing and on the white labels. You're saying you're ready to price undercut. Does that mean we're going to start seeing pressure on the white label side too?
I'll take a first shot here, and then Everett, maybe I'll give you an opportunity to discuss as well. But John, I think what you're seeing is on our profile. What we really provide is our customers to establish a brand in whatever segment that they want to establish it. So if they have a premium offering, they can price at a premium price point and enter the market, and our infrastructure will allow that. But if you want a more cost competitive product or a lower cost item, our platform can also allow that, based on the capabilities we have. So I think we're facilitating a broader amount of price points in the market. But if I would say, I'd say in the near term, it's sort of that value segment that is experiencing a lot of attention, and where we expect there to be a strong growth in the short term. Everett, do you have anything to add?
Yeah, John, I think that from the custom manufacturing side, it's really a tailwind for us. If you look at the amount of dried cannabis in inventories earlier, in future quarters, especially going into 2021, I think we can really, as we are selling mostly end products on the manufacturing side and distributing them, our input cost is going down dramatically, right, on that front every single day, which is really a tailwind for margin going into that 2021. So I think that's an opportunity. I think, and just to reiterate Jeff's comments, we're the lowest cost producer as an extraction company in the cannabis space from our knowledge today. So I think that, yes, we've seen compression on oil sales, which is not as big of a core competency for us. We've already been more strategic on the custom manufacturing side, but the extraction footprint, I don't think we're worried about the compression on that, and we haven't seen as much as the distillate sales side.
And earlier you talked about just looking at the credit worthiness of customers, and that's an ongoing thing for the company. So maybe just give us an update in terms of the existing customer base, but also potential customers that maybe you've had to turn away just because you didn't think that their ability to pay down the road was quite up there. So maybe just give us a sense of how that's been playing out for you.
And maybe Chris, I'll turn this over to you.
Certainly. Yeah, so as we onboard and look at bringing new customers to the team from a control standpoint, that is kind of one of the critical steps that we go through to evaluate creditworthiness of all of our partners. On the white label side of things, I guess it's mitigated in the structure of those agreements from a royalty standpoint, with us selling direct into the provinces, kind of mitigates that risk in that category quite significantly. But on the extraction side, specifically, it definitely is a focus and something that the team looks closely at, specifically in the environment that we're operating in today.
And John, to be clear, the discussions, as we're doing our pre-work and making sure that we're comfortable with the profile, it's really more about risk mitigation. So, questions where there may be challenges in any given customer, the conversation moves to structure of the deal and how to limit that risk and that exposure. Because obviously, everyone in the current market, there's challenges ongoing. We're in the business of bringing brands to market. So, it's not like we're going into conversations, looking to say no to people. It's more we want to properly assess the risk and make sure that our structure properly accounts for that.
Okay, I'll get back in the queue. Thanks.
Thank you. Our next question comes from the line of Shan Mur with Canaccord Genuity. Please proceed with your question.
Good morning. Thank you for taking my question. The first one here is just on the beverages and edibles category. So we saw reports of strong demand for those 2.0 products as the stay-at-home measures that came into place earlier. I think beverages and edibles are about 25% of sales in May. So as the summer months start rolling around, we're seeing these restrictions kind of loosen off, and people aren't at home as much. So have you seen from your level of visibility any shifts on the demand or the market share side for these beverages and edibles products? And are they trending upwards or downwards into June, July, the summer months where people aren't at home as much and they might be, shifting more towards a vape or a flower type product?
I'll let Tyler come in and comment on sort of a larger trend and view, but in the short term, I'll say no, we haven't noticed any decline. I think, especially from the beverages perspective, remains strong and growing. If I look at sort of the offering that we put in the market relative to other markets where beverages are perhaps a lower percentage of the overall pie, in Canada, given some of the technologies that we have out there and the quality of experience that we're providing, we continue to believe that segment will be, a larger segment in the Canadian context. But in the short term, we have not seen a shift in that demand profile. I don't know, Tyler, is there anything to add?
Yeah, no, I'll echo basically exactly what you said. So month over month growth as far as beverages go. A lot of people don't understand the caloric intake of the beverages we put on the market. So they're rather healthy. They're no hangover. So we see a tendency of people actually moving away from alcohol into those beverages. And I can't really comment on edible growth right now because that's something we've never really gone after. Looking after the health and wellness aspect of the way trends are going with consumers right now, I'm not really a big advocate of eating chocolate or anything like that. So we really went after the low caloric intake of beverages and the consumer experience. So we see nothing but blue sky going forward and really bringing different formats or different potency beverages to the market so the consumers can have options. Right now, we've only launched essentially 2 at the 2.5 milligrams per serving. You're going to see some other ones on the market in the very near future. So beverages are full steam ahead in my mind.
And Sean, it's Everett here. Maybe just to expand on that comment too, like that we were impressed with the sales in May in Ontario, where 25%, as you said, came from edibles, vapes, and beverages. But if you look at that category, of the edibles category, beverages made up 28%. And that's the fastest growth we've seen. So as Tyler mentioned, we're seeing that growth continue. And 25% for the 2.0 category is way ahead of analyst estimates. And I think what you're going to see that is it's continue to exceed those expectations, at least what we're seeing on our side. And if you look at the U.S. marketplace from a roadmap for Canada, it's really a greater than 50% of the products now are oil-based products, which is really our core competency as a manufacturer. So I think you're going to continue to see that growth, and we continue to see that ramp up.
Thank you. And then just shifting to the international front, I just wanted to touch base on that Canvalate agreement. Has there been any discussions to get a first group of products over into Australia? Kind of where are you in actually monetizing on that agreement right now?
So we expect to have our first shipment, as you said, in the body of the call in Q3, our Q3. And we are very encouraged and very happy with the relationship we're building with Canvalate and the opportunity that is surfacing for us. So right now, I'd say definitely Q3, and then very excited about opportunities to bring additional products on in the very near future.
Okay, and just to follow on that, is there a specific product format that they're looking towards? Is it vapes or tinctures, oils?
Everett, I want to give you a shot at this one.
Sure. You know what? It's really starting like in the marketplace today. If you look at Australia, it's 95% oil-based products, right? So if you look at on the market, it's dominated by tinctures, but soft gels are kind of fast coming up. I would say that as we get into CBD marketplace expanding, which is expected to be descheduled from Schedule 4 today to Schedule 3, you're going to see the variety of those products. So the conversation with Canvalate, you'd be surprised at the wide variety of products we're doing, not just tinctures, but beverages and topicals and vapes. As that market expands, we're already having those conversations and got development plans in place.
Perfect. Thank you.
Thank you. Our next question comes from the line of David Kideckel with ATB Capital Markets. Please proceed with your question.
Thank you. I just want to circle back on something. I mean, you guys have a solid balance sheet, great credit facility as well. And I think, Jeff, you mentioned that you believe that the Valens stock is very heavily discounted. We would agree with that too. My question is then on the, before, as you mentioned in your prepared remarks, with the ramp of 2.0 products moving into the back half of 2020, just given your ample liquidity here, is there an opportunity for you guys to be even more aggressive on your stock buyback? Thank you.
Certainly, David, and this is something that we discuss often, and we balance against a number of opportunities. In the short term, we are active, but taking a cautious view of this. Given we're very comfortable with our balance sheet, but we're very protective of our balance sheet and making sure that we continue to have the financial resources and flexibility to pursue the opportunities that are presented to us. But at the same time, wanting to drive that near-term value or immediate value that gets delivered to shareholders through the buyback. So we have this conversation often. We will continue to be active. We will continue to pick our spots, and not only supporting the stock, but also driving value to shareholders.
Thank you.
Thank you. Our next question comes from the line of John Chu with Desjardins. Please proceed with your question.
Hi, just wanted to follow up on the biomass that was processed in the quarter. It was actually a lot higher than what we had thought. So maybe and I know some of that probably went into work in progress in terms of your oil inventory, but can you give us a breakdown in terms of hemp versus cannabis, and then just kind of how that outlook for processing volumes looks going forward?
Chris, do you want to take this one?
Certainly. So we look at the volume that we processed in May. As we mentioned in our commentary, a large portion of that was kind of shifted to our own biomass. As far as split goes, it was fairly even between hemp and cannabis in the quarter, which aligns with kind of what we're seeing from inventory levels, from our own internal inventory levels of CBD and THC, which we're kind of managing to be able to fulfill the demand that we're seeing for the white label products.
Okay, and then just another follow-up question. I thought Tyler said on the call earlier that there's higher margins on the white label side. Can you just maybe go over the margin profile for custom manufacturing or white label versus the tolling? I thought the tolling was a higher margin business.
Given you reference Tyler, do you want to take this one?
So I guess I can speak to that. I think the comment on the white label side is that it's certainly a high margin business for us. By far, tolling, if we're looking at it from a percentage standpoint, is higher than the white label side, but we're still pleased with the margins that we see on the white label side of the business.
And actually, does it matter if it's...
Sorry, and John, just to be clear, if there was comment or interpretation that we said that the white label was a higher margin business, and that's not what was intended to say. We did not intend to say that.
Right, and that's what I thought. So that's why I just wanted to make sure I heard that right, to clarify that. And then maybe just describing the margin profile between cannabis versus hemp-based products. Can you just maybe give us a little bit of an insight on that?
Sure. Chris, do you want to go after this one as well?
Sorry, can you repeat that?
Yeah, hi, Chris. I'm just curious about the margin profile for a hemp-based product versus a cannabis-based product. Are the margin profiles for white label similar, or is one higher than the other?
No, overall they're fairly similar. Largely based on kind of the inputs that we're seeing from a biomass. We've been able to source recently some well-priced cannabis, and we do have agreements in place on the hemp side as well for favorable pricing from our view. So overall, similar margin profiles between the two.
And sorry, Chris, maybe the last question. Maybe just on the inventory. Obviously, is there a risk of any more write-downs on that? Thanks.
At this point in time, we're comfortable with the valuation from an inventory standpoint. Again, kind of continuing to kind of monitor developments and compression that we've seen in pricing historically. But as we kind of shift and start to deploy this inventory into kind of consumer packaged goods through our white label program, and being able to realize more value off of that, that will, I guess, further mitigate the risk of additional write-downs in the future as well.
Okay, great. Thank you.
Thank you. Our next question is from the line of Jenny Wang with 8 Capital. Please proceed with your question.
Thank you. Just following up on a comment I think Chris made. In terms of, are you seeing any opportunities right now kind of to buy dried hemp or dried cannabis at lower prices? Or kind of what kind of trend are you seeing in terms of wholesale prices? Are they coming down quite dramatically or stabilizing? Or any insight there would be helpful. Thanks.
I think, and Chris, I'll open the door for you to add at the end here. But overall, yes, there is downward pressure on pricing on the wholesale market from a flower perspective. I'd say for sure. But I also say that there's opportunistic purchases that we make based on different relationships and different opportunities for us to buy some attractive product, and that's one of the benefits of the balance sheet that allows us to be opportunistic and realize those lower price inputs. Chris?
Yeah, I wouldn't have anything further to add to that. That's definitely our strategy and what we're seeing in the market today for sure.
And Jenny, maybe just to expand Everett here, I think that's a tailwind, as I mentioned, long term. Like I think you're seeing a continual disproportionate compression on the dried cannabis with the inventories we talked about, and I think that's in the future as we get more into the manufacturing side, we have more stability on prices going into the provinces, meaning that if our input pricing comes down, it goes into the margins for us. So I think that's something to watch for. And as Jeff mentioned, we continue to have relationships, and now that we're the biggest buyer of dried cannabis in Canada, I mean, we get very attractive pricing that I think would surprise you in the future.
Got it. Thank you.
Thank you. Ladies and gentlemen, at this time, there are no further questions. I would like to turn the floor back to management for closing comments.
Thank you, operator. As we continue to develop the Valens company into a premier manufacturer in the cannabis space, we have diversified our business beyond toll extraction and truly emerged as one of the only one-stop shops for product development, manufacturing cannabinoids-based products in the country. We have played a dominant role in the creation of both the extraction and manufacturing marketplace and continue to lead with the largest offering of extraction techniques and manufacturing and product format capabilities in the sector. We are not immune to the obstacles of building this nascent industry, which we undoubtedly have been impacted by COVID-19 pandemic. But we believe the platform we have created is fully adaptable to the changing market conditions and as a result of the breadth of services we can offer. Further, we have made significant progress in the rollout of our white label and custom manufacturing program and believe this progress will lead to stronger revenue growth in the second half of the year and beyond as these customer agreements gain momentum. Our investments in proprietary technologies and our advancements in R&D capabilities are expected to further entrench our position as the leading producer of high-quality, differentiated products and drive value in the months to come. In closing, I would like to thank all of our shareholders for your ongoing belief in our business, allowing the Valens company to grow as a pioneer in the industry, as the truly only third-party cannabinoid-based product manufacturing business today. The evolution of our business into a premier manufacturer has begun, and we are fully confident in the resources and capabilities we possess to lead on a global scale. With that, I'll ask the operator to close the line.
Thank you. Ladies and gentlemen, this concludes today's teleconference. You may disconnect your lines at this time. Thank you for your participation.